Hey there. Look, while every property investor is chasing growth suburbs, there's a silent killer lurking in Australia's housing market: oversupply. Today, we're exposing the suburbs and precincts where new dwelling supply has spiraled out of control. Vacancy rates are climbing and capital growth has flatlined. Know where these are, and you'll know exactly what to avoid in 2026. So we've actually crunched the data on building pipelines, completion rates, and vacancy trends across every major city. And I'll reveal one metric that separates safe investments from oversupply traps, a ratio that most investors completely miss. So stick around. Welcome back to the channel, where we make sure your capital moves are backed by data, not emotion. Today's episode is critical. We're diving deep into one of the most expensive mistakes Australian property investors make: buying into oversupplied markets. So here's the harsh truth. While headlines celebrate housing shortages and growth, certain pockets across our major cities are sitting on dangerous supplies of new dwellings. And when new supply crushes demand, what happens? Prices stagnate, rents fall, capital growth evaporates, and worse, your equity can go backwards. And today, we're pulling our proprietary data on building pipelines, completion rates, vacancy trends, and dwelling approval ratios to expose exactly which suburbs and precincts are oversupplied and why they should be on your avoid list. This is the information that separates wise investors from expensive mistakes. So Australia's caught in a bit of a paradox here. Headlines scream about housing shortages. Government targets aim for 1.2 million new dwellings in 5 years. But underneath the data tells a messier story. Here's what's actually happening. According to the Australian Bureau of Statistics, there are currently 219,000 dwellings under active construction across Australia. On top of that, another 30,000 have been approved but haven't begun construction yet. That's a total pipeline of 249,000 homes in various stages. Sounds like plenty, right? You'd be wrong. The problem isn't approvals, it's delivery. Building activity data shows dwelling commencements are falling, completion rate times are stretching out, and construction costs are skyrocketing. In the March quarter of 2025, just 39,700 dwellings commenced construction, which is down 13.5% year on year. But here's where it gets really concerning. Completion rates aren't keeping pace. In the same quarter, only 41,300 dwellings were completed. More commencements are stalling, which means the pipeline is getting congested. And when pipelines get congested, delivery drags. When delivery drags, timing misaligns. So projects approved during boom phases get completed after demand has actually softened. This time lag creates a dangerous mismatch. You end up with a glut of new supply hitting the market precisely when fewer buyers actually want it. And that's when oversupply strikes. So here's the metric most investors miss: the building approval ratio. This is the number of dwelling approvals in a specific suburb relative to the existing housing stock, expressed as a percentage. What's the safe threshold, you might be asking? Well, generally anything below 5% is healthy. 5 to 10% is starting to get a little risky. Anything above 10%, you're now into oversupply territory. So let me show you some real examples. For example, Ripley Valley in Brisbane, which is a planned development precinct in Brisbane's outer west. So our analysis shows a building approval ratio of 72%. So 72% more dwellings are approved to be built compared to the existing stock. This isn't healthy growth, this is overdevelopment. When this supply hits the market, there simply isn't enough demand to absorb it. So what's the result? Stalled capital growth, rising vacancies, and rental pressure. Schofield and Rouse Hill in Sydney, the northern west corridor. Schofield has 3,397 apartment approvals. This represents 115.7% of the existing stock. 115%. Rouse Hill has 1,224 apartments approved, which is 88.2% of existing stock. These suburbs are drowning in apartment supply. And because apartments typically have longer delivery times, this stock hits the market in waves, crushing prices as supply exceeds demand. Then we look at Gosford, Central Coast, New South Wales. 1,619 units approved over 24 months. That is a 28.2% of existing stock. While lower than Sydney's northwest, Gosford's coastal town scale makes this outsized. Coastal buyers have options. When apartments flood the market, renters and owners have negotiating power. Then looking at Melbourne, we've got Williams Landing, part of Melbourne's Western Growth Corridor. The approval ratio is around 18% based on current development pipelines. While marketed as a planned community, the sheer volume of new apartments hitting the market has coincided with rising vacancy rates, now sitting at 5.28%, well above the healthy threshold of 2.5%. The warning sign is clear. When approval ratios exceed 10%, expect supply absorption challenges within 12 to 24 months of peak completions. The vacancy rates don't lie. When they spike above 3%, the market is in excess supply. Tenants gain negotiating power. Rents start to fall, and when rents fall, investor yields compress, which triggers forced selling. Our analysis of vacancy data reveals some troubling clusters. We've got Melbourne's Western Corridor danger zone. Seabrook at 6.45% vacancy. That's nearly triple the healthy threshold. Williams Landing at 5.28%. Burnside Heights at 4.7%. Malvern East at 4.13%. What's driving this? Massive new apartment developments coinciding with softened demand due to high interest rate demands and investor pullback. These suburbs approved hundreds of new apartments just as borrowing capacity compressed. So the capital growth picture here, flat to negative. Rents are falling, days on market are climbing. Investors who bought during the approval boom are now facing negative equity and rental yield compression. Then we look into Sydney's northwest crisis. While official vacancy data shows the northwest performing better than Melbourne's fringe, the underlying pipeline data screams absolute warning. Oakville, Box Hill, Rouse Hill, Marsden Park, and Riverstone all show significant detached house oversupply, with Oakville recording the highest at 13.4% of total housing stock currently listed for sale. When listings spike, it signals forced selling, investors exiting positions due to stalled growth or negative cash flow. Then we look towards South Australia, Adelaide's emerging concerns. While South Australia has tighter rental markets overall, specific precincts are showing warning signs. Suburbs with new large-scale housing developments show rising vacancy clusters. Affordability attracts volume supply, which can quickly flip the market from tight to loose. The national vacancy rate sits at 1.2%, which is historically tight. But this masks critical regional variations. So smart investors look beyond the headlines and dig into suburb-level data. So here's a hidden danger: the lag between when a dwelling is approved and when it completes. Traditional build times used to be 12 to 18 months for detached housing, 24 to 36 months for apartments. Today, completion times have blown out dramatically. According to construction industry data, the average apartment completion time in Sydney and Melbourne is now stretched to 42 to 54 months from commencement. Why is this? Labor shortages, material costs, supply chain delays, and building code changes. This matters enormously, and here's why. So a developer receives approval for 300 apartments in a new precinct in 2022. When interest rates are at historical lows and buyer demand is explosive, they break ground in 2023. Construction stretches through 2024 and 2025. By the time units complete in late 2025 or 2026, the market has shifted entirely. Interest rates have risen, buyer sentiment has cooled, investor lending has tightened, and suddenly you have 300 new apartments hitting a market with far less demand than they were approved. This exact scenario played out in Melbourne's West. Apartments approved during the 2021-2023 boom are completing exactly as interest rate pressures have dampened demand. The result? oversupply hitting a weakened market. Regional areas face similar timing misalignments. The Gold Coast's, Brisbane's western precincts, and even Perth's emerging developments are all facing this dynamic, supply timed perfectly wrong. So here's another signal: rental yields. When a market becomes oversupply, rental growth lags price growth. Or worse, rents actually fall while vacancy climbs. Our yield analysis reveals apartments in oversupply precincts now deliver 3.5% to 3.8% gross yields. In a balanced market, 3.8% is acceptable. But when it's paired with rising vacancy, weak rental growth, and above average capital depreciation, it's a disaster. Compare this to apartment yields in tight markets, which are generally at 4.2% to 4.7%, where vacancy remains below 1.5% and rents climb annually. The yield gap is your warning signal. So Melbourne's Western Growth Corridor, as an example, looking at Seabrook apartments, the yields have compressed to 3.2%. Williams Landing apartment, 3.4%. Meanwhile, vacancy rates are at 5+%, meaning there's downward rental pressure that are continuing. Compare this to a tight market like South Brisbane or North Melbourne. Yields are at 4.2% to 4.6%, with vacancy well below 1%. The yield premium for lower risk, tighter markets is massive. Then the Sydney's Northwest Danger. Apartment developments in Rouse Hill, Schofields, and surrounding areas show early yield compression signals. As approval pipelines flood with new stock, rents are failing to keep pace with price expectations. Investors chasing growth are locking in mediocre yields at the top of the market. The pattern is very clear. When yields are compressed below 4%, combined with rising vacancy, you're in an oversupply market and you need to avoid it. So finally, track days on market and listing velocity. When homes sit on market longer than the average, demand is starting to soften. So current data shows oversupply precincts see days on market 20 to 40% above the city averages. In tight markets like Redcliffe in Brisbane or South Brisbane, properties sell within 5 to 10 days. In an oversupply suburb like outer West Melbourne growth precincts, homes linger 40 to 60 days. Longer listing periods indicates buyer reluctance, which means there's too much choice and stalled growth expectations. There's forced sellings, which leads to negative equity and cash flow pressures. And there's price resistance, which means that owners there are holding on to unrealistic expectations. So when you see listing velocity accelerate in a suburb, i.e. more homes listed each week, paired with extended days on market, that's your data-backed warning. So here's the complete framework we use to identify oversupply risk. Number one, building approval ratio above 10%. That's a red flag. Number two, vacancy rates above 2.5%. That's your warning sign. Number three, rental yields below 4% combined with rising vacancy. Number four, days on market 30% above the suburb average. This is an oversupply signal. And number five, completion time lag between approval and delivery exceeding 36 months. This indicates again a timing mismatch risk. If a supply ticks 3 or more of these boxes, it's most likely oversupplied, and your capital is better deployed elsewhere. If you found this data analysis valuable, please hit the like and subscribe. Drop a comment below with any suburb you're concerned about, and we'll run an oversupply analysis on it and feature it in an upcoming video. This is the kind of defensive analysis that protects your capital and accelerates your wealth. And now you're equipped with it too. So if you're serious about avoiding these traps entirely, I want you to think about joining our exclusive members group. You'll get access to our live Oversupply dashboard, updated monthly with building approvals, vacancy data, completion times, and yield analysis for every major suburb in Australia. We also provide quarterly danger zone reports, identifying emerging oversupply risks before they hit mainstream awareness. This defensive intelligence is how you protect equity while hunting for growth. I want you to book a call in today. Let's ensure your next property move avoids the oversupply trap that amateur investors fall into. Thanks for watching.